Welcome to Financial Statement Analysis. Under Chapter 3, we are going to learn foundations of ratios and financial analysis. In Part 1, we are going to go more detail with regard to the financial analysis. Now let's see what is financial analysis. Financial analysis uses the financial information to evaluate companies' performance and offer suggestions for how it might move forward. Financial analysis is the process of properly constructing relationship between the items of the statement of financial position and the income statement in order to discover the firm's financial strengths and weaknesses. It is also known as using financial data or financial statement interpretation to get the desired outcome. There are many needs and objectives of financial statement analysis. It helps to disclose other information according to the needs of the users. It helpful in assessing the financial position and profitability of the concerned entity. It helps to assess the present and future earning capacity. It helps to assess the operational efficiency of the firm as a whole as well as various departments or various parts. As well as it enables to assess the short-term and long-term solvency of a firm for the benefit of the debenture holders and creditors. It also helps to assess the financial stability of the firm. And finally, it enables to assess the long-term liquidity of its funds. There are types of financial analysis. First one is the external analysis. It is done by the outsiders who don't have the access to the details of internal accounting records of the firm. This includes investors, potential creditors, potential government agencies, and the general public. They entirely depend on the published financial statements and serve only a limited purpose. Whereas the internal analysis is done by the persons who have the access to the internal accounting records of the firm. It can be performed by employees of the organization as well as government agencies which have the authority or the statutory power vested in them. Other than the internal and external analysis, there are some more tools which can be used by financial analysts. The first one is the horizontal analysis. It refers to the comparison of financial data of a company for several years. It is also called dynamic analysis as well as the comparative analysis. The figures of the various years are compared with the base year. The figures for this analysis are presented horizontally over a number of columns. It makes it possible to focus attention on the items that have changed significantly. The next one is the vertical analysis. It refers to the study of the relationship of the various items in the financial statements of one accounting period. It's also called as static analysis, as it takes only the current year data and it is not considered the rest of the years. It can be made along with the horizontal analysis. The next one is the cross-sectional or inter-firm analysis. It involves the comparison of financial data of a firm with other firms or the competitors or the industry averages for the same time period. By benchmarking company's result against its peers, a company can determine if it is above or below the average. It can be then worked to address the weaknesses or to exploit strengths. Let's move on to the common size analysis. Common size analysis is a major tool that financial managers use to analyze financial statements. A common size financial statement displays line items as a percentage of one selected or common figure. Common size analysis can be conducted in two ways, that is, vertical analysis and horizontal analysis. Vertical analysis is a method of analyzing financial statements that list each line item as a percentage of a base figure within the statement. This means that every line item on an income statement is stated as a percentage of gross sales, while each line item on the statement of financial position is stated as a percentage of total assets. So, the vertical analysis formula is the line item should be divided with the base figure and then it should be multiplied with 100 to take the percentage. So, in the vertical analysis income statement, each line item in the income statement should be divided with the sales and should be multiplied by 100. And each item on the statement of financial position should be divided with the total asset to take the vertical analysis of the statement of financial position. Horizontal analysis look at the item's percentage change from one financial year over the other financial year. Here they are going to change the change in the financial statement over two or more accounting periods. It represents the percentage change in the same line item of the next accounting period compared to the value of the baseline accounting period. So let's see how we are going to calculate it. First, we have to take the difference between the comparison year and the base year, and then this difference should be divided with the value of the base year amount. Now let's see the difference between horizontal analysis and vertical analysis. Let's look at the definition first. Horizontal analysis is the comparative evaluation of the financial statement for two or more periods to calculate the absolute and relative variance for every line of item. Whereas vertical analysis is a proportionate evaluation of the financial statement wherein each item on the statement is expressed as a percentage of the total or the base value in the respective section. In the horizontal analysis, it represents the growth or decline of an item. But vertical analysis help in forecasting and determine the relative proportion of an item to the common item or the base item in the financial statement. Horizontal analysis is used to ascertain the trend and changes in an item over the time period, whereas vertical analysis aim to ascertain the proportion of the items to the common item of the single accounting year. In the horizontal analysis, the item for the past financial statements are restated to the percentage of the amount from the base year, whereas in the vertical analysis, each item of the financial statement is denoted as the percentage of another item. Horizontal analysis help in intra-firm comparison, and vertical analysis help in both intra-firm comparison as well as inter-firm comparison. Let's see the advantages of common size analysis. Actually, this can be used for intercompany comparison with the companies with different sizes. And it is effective in understanding key trends over the time. It helpful in analyzing structural composition and how that structure is changing over the time. It will represent the most effective way to compare companies' financial statements to the industry averages. And also it helps to reveal the missing drivers. Now, let's identify the disadvantages of common size analysis. There is no standardized ratios or percentage to follow. So there is no fixed norm to identify the change of percentage in various components of assets, liabilities, sales, etc. Then this common size analysis is unable to capture the effects of inflation, exchange rates, or the other external factors such as seasonal fluctuations. And the differences in the accounting policies, methods, or standards is not taken account. If there is an inconsistency in the accounting principles, concepts, and conventions, then this common size analysis become useless. We know that window dressing is a key issue in the financial statement analysis. This has an impact to the common size analysis as well. The common size statements fail to identify the real position of the sales, assets and liabilities due to this evil effect of the window dressing. Finally, this common size analysis is failed to recognize the qualitative elements such as quality of work, customer loyalty, customer relations, etc. Let's learn more with regard to the cross-sectional analysis. It is the inter-firm comparison of a firm for a particular accounting period with one or more similar or comparable firms in the same line. This analysis is effectively capable in the distress analysis, portfolio analysis, measuring creditworthiness, and locating structural difference of firms with industry standards. Now let's look at the advantages of cross-sectional analysis. The first one is we can easily identify the position of the firm, and comparison with industry norms become easier in the cross-sectional analysis. If a firm position is found out to be a better or higher than the industry norms, then it enjoys the goodwill and it can acquire it for building public image. Let's look at the disadvantages of cross-sectional analysis. We know that in the cross-sectional analysis, we are going to compare the interfirms. However, the past trends can be calculated, but future trends cannot be predicted in the firms in the same industry. We know that past data may fail to supply the necessary information if there are major changes in the economic, social, political, or technology. We know that companies' performance can be calculated. An overall picture can be drawn easily. However, it does not help the firm to ascertain or identify or to compare it with the firms in the same industry by using the industry averages. Finally, industry norms not may be even a sound one. So it's in vain to compare the industry average when we are going to analyze the firm. Time series analysis. Time series analysis can be useful to see how a given asset, security or economic variable changes over time. It can also be used to examine how the changes associated with the chosen data point compared to shifts in other variables over the same time period. Let's look at the advantages of time series analysis. It supplies information relating to the financial position for number of years. A graphical representation provides information related to the ups and downs of the firm easily by using this time series analysis. Proper precautionary measures must be adopted well in advance by seeing the forecast of the time series analysis. Performance of the firm can be compared with the industry averages in this analysis. There are some disadvantages too. In the short term, time series analysis is not found to be suitable. It is applicable in the long-term analysis. It is very helpful to evaluate the overall performance of the firm. However, if you are going to evaluate a department or section or branch-wise, then it may not be a useful tool. The ups and downs do not follow a part cyclical patterns, since innovations helps to avoid downward trends. So this time series analysis may not be useful if there are more random variations, seasonal variations or cyclical variations. It does not find mistakes in the grassroots level of management. Therefore, there are some difficulties to measure the performance. Now let's identify the differences between the time series analysis and cross-sectional analysis. First, let's look at the data type. Time series data consists of observations of a single subject at multiple time intervals, whereas cross-sectional data consists of observations of many subjects at the same point in time. The main focus on the time series analysis on the absolute performance of the asset. And in the cross-sectional analysis, the focus is on the relative performance of the asset over the same time period. So analysts use this time series data to track the changes over the time, whereas they use this cross-sectional data to compare different companies at one point in time. Another form of analysis is the trend analysis. Trend analysis is a form of analyzing financial data and it is expressed as a percentage for each year. It helps the accounting users in evaluating the financial performance of the business and also forms a point on various tendencies. Do you have an idea what is the difference between the trend analysis and comparative analysis? Trend analysis is an analysis of firms' financial ratios over time. It is used to estimate the likelihood of improvement or deterioration in the financial situation. Whereas the comparative ratio analysis is when a firm compares its ratio over other leading companies in the same industry. This is a technique used for benchmarking. Trend analysis can be used to identify the trends. It can be used to make inter-firm comparisons. As well as trend can be used to make predictions about the future performance of the company. And it can be used to measure the financial performance as well as it can be used as a tool to identify the liquidity position of a firm. Now let's see what are disadvantages of trend analysis. Trend analysis is primarily based on historical data, which does not guarantee that the company will follow the similar pattern in future. Trend analysis is subjective in nature. It can be subject to different interpretations, different accounting methodologies, different accounting principles, etc. Trend analysis can often generate inaccurate signals. It may lead into poor decisions. Therefore, these false signals can be leading to various circumstances like unexpected news event, market volatility, short-term fluctuations in the company's stock prices, etc. Also, in the trend analysis, there is a challenge of identifying the turning points. At the same time, in the inflationary period, data given by the trend analysis may be incomparable. Let's distinguish trend analysis and comparative analysis in more detail. As I mentioned you earlier, trend analysis is designed to look for the trends in a business performance over time, whereas comparative analysis is designed to compare changes from time to time. Trend analysis is analyzed in horizontal method. It adopts the line-by-line method, whereas the comparative analysis analyzed in horizontal as well as vertical methods. Trend analysis is useful to compare its result with previous years to estimate the likelihood of improvement or deterioration in its financial situations. Whereas comparative analysis is useful in comparing its result with previous financial years and also can be compared with similar industries. Trend analysis can be interpreted in absolute terms as a percentage and in graphical forms. But comparative analysis uses the ratio calculations. Business analysis is another form of analysis. Business analysis is the evaluation of companies' prospects and risk for the business decisions. Financial statements are the most comprehensive sources of information about a company. As a result, financial statement analysis is an integral part of the business analysis. Fundamental and technical analysis are different tools which used to measure the organizational performance. Fundamental analysis focus on the financial health of companies. Thus, fundamental analysis emphasizes on the company's financial statements, whereas technical analysis look at the price movement of a security and use this data to attempt to predict future share price movements. Fundamental analysis takes long-term approach in investing compared to the short-term approach taken by the technical analysis. Now let's identify more differences between fundamental and technical analysis based on different criteria. First, look at the meaning. The fundamental analysis of stock based on the calculations of its intrinsic value, whereas technical analysis of stock and prediction of its prices by using the trends and charts about its price movement. Normally, the purpose of the fundamental analysis is to evaluate the intrinsic value of the stock and make a decision regarding the investment, whereas the purpose of the technical analysis is to correct time to enter or exit from the share market with respect to stock based on the predicted future prices. Normally, fundamental analysis focusing on the long-term investment and technical analysis focusing on the short-term investment. Fundamental analysis take the decisions based on the historical financial statements and present data. But technical analysis always predict on the historical share prices. Fundamental analysis is mainly based on the financial statements and the company's present and past performance, whereas technical analysis use charts and trends as the source of data. As I mentioned you earlier, fundamental approach use the long-term approach, whereas technical analysis use the short-term approach.